Ever feel like the stock market's movements are a mystery? Kind of like it's dancing to a tune only a select few can hear?
I know exactly what you mean. It can definitely seem that way.
Yeah. Like we're watching this intricate ballet, but just can't grasp the rhythm?
What if we could travel back in time, though?
Ooh, like a financial time machine.
Exactly. Go back a century, peel back the layers of market history, and maybe, just maybe, find some clues in the echoes of the past. Think we could learn something about where we stand today.
Well, that's precisely what we're doing today. For you, the learner. A deep dive, specifically curated with insightful information.
A deep dive into
We're going to explore a chapter by Benjamin Graham.
the Benjamin Graham, father of value investing, right?
That's him. We're talking about the legend himself, and we're going to pair his insights with some sharp contemporary analysis from Jason Zweig.
Sounds like we're about to unlock a 100-year-old financial puzzle.
And we've got the modern key to do it. But our mission here isn't to just drown you in a sea of statistics, right?
Yeah.
No. We're not about that. We're about to extract those core patterns of how the market moves.
Exactly. We want to understand that fundamental connection between stock prices, those company earnings, and of course, dividends.
The trifecta.
And honestly, just get a handle on the different ways we can even interpret this historical data, but we're going to make it clear, engaging, and conversational. Not a lecture, promise.
Definitely not a lecture. So, at the core of all this, what's our main source material for this deep dive?
It all starts with Chapter 3 of Benjamin Graham's work, A Century of Stock Market History, the level of stock prices in early 1972.
Okay.
This is a really remarkable piece because he looked back at a full 100 years of market data, all the way from 1871 up to 1972.
Wow.
He pulled a lot from the Cowles Commission study, which, by the way, was this groundbreaking early attempt to compile long-term market data.
Right.
And then he connected that to the more modern S&P Composite Index and the one everyone knows, the Dow Jones Industrial Average, the DJIA.
Right. The DJIA rolls right off the tongue.
Yeah.
So we're talking a really expansive view, a century-long lens.
Exactly. And to bring it all into the present day, we've got Jason Zweig's commentary. He builds upon Graham's work with his modern-day wisdom.
All right, so let's really get into it through the eyes of Benjamin Graham back in early 1972. First things first, what was his motivation for diving so deep into all this past data?
Well, Graham, as one of the, foundational thinkers in value investing,
Right.
he was deeply interested in understanding those huge swings in stock prices, the booms and busts. But more specifically, he wanted to figure out the link between those prices and the actual health of companies, how much they're earning, the dividends they're paying out.
I see.
Ultimately, his goal was to use all this historical understanding as a framework to judge whether the market at any given time was offering good value or was it a bit risky?
Was it a good time to buy or not? Makes sense. And to do this, he used some key indicators, right? Those stock market indexes.
Yes, he mainly focused on two. The combined Cowles Commission and S&P Composite Index, that gave him a wide view of the market.
Okay, so a broad picture.
A broad picture. And then the DJIA, the Dow Jones. And while it only includes 30 of those big U.S. companies, it has a much longer history, going back to 1897.
Right, the DJIA, very established. He did note the difference in their size, though.
He did. He mentioned that the S&P 500, it covers 500 companies versus the Dow's 30.
So he's got these tools. He's looking back at a century of data. What were some of the big patterns that jumped out at him, particularly when he looked at the S&P Industrial Stock Index from 1900 to 1970?
He actually divided those 70 years into 3 distinct phases, each with its own flavor. The first phase, 1900 to 1924, that was all about relatively stable cycles, like clockwork 3 to 5 years.
Interesting. So consistent cycles back then.
Pretty much. And the average annual price increase was a modest, around 3%.
3%. Not exactly setting the world on fire.
No, it wasn't a rapid growth period. It showed that not every period delivers those massive returns.
A steady climb.
Wow.
Okay, so what came after that?
Well, the next phase, 1924 to 1949, that was a wild ride. And honestly, not as rewarding overall.
Oh.
It started with what they called the New Era bull market in the late 20s.
The Roaring '20s, right.
That's it. But then, of course, boom, the crash of 1929. And after that, it was a long period of very uneven and unpredictable fluctuation.
Oof, that's rough.
It was. And when Graham compared the market in 1949 to 1924, the annual growth rate was a measly 1.5%.
1.5%, wow. So not exactly the high-flying Roaring '20s everyone remembers.
Not at all. Graham pointed out that this actually led to a lack of public interest in stocks. Like, people were just turned off by the whole thing.
Discouraged.
Exactly. And that's important because, sometimes those low points can actually be the setup for something bigger.
Okay, so what was that something bigger?
That brings us to the third phase. From 1949 to 1968. This, in Graham's view, was the most powerful bull market in history up to that point.
Wow, so this is where things really took off.
Big time. Sure, there were dips, like 56, 57, and 61, 62, but the recoveries were so strong and fast that it was like, just a pause in a much larger upward trend.
Not the end, just a blip.
Exactly. And the gains were huge. The DJIA, for example, increased more than sixfold during those 19 years.
Sixfold? That's got to be some kind of record.
It was an average compounded return of about 11% per year, and get this, that's not even counting the dividends.
Unbelievable. And the S&P composite did even better.
Even better. So you can see why after a period like that, people might start to think this is just how it is now.
Yeah, like the market had permanently shifted to a higher gear.
Right. But Graham was cautious. He warned that this massive rise could make investors blind to potential risks. He pointed out that from the peak in 1968 to the low in 1970, the market dropped significantly, about 36% for both the S&P and the DJIA.
36%. So a pretty big reality check after those years of gains.
It was the biggest drop since the World War II period. Yeah, a reminder that markets can swing both ways.
And this, of course, is what leads us up to that early 1972 period he's writing about. But didn't the market recover quickly after that drop?
It did, actually. After that low point in May of 1970, both the S&P and DJIA bounced back pretty fast.
So back to those highs.
Back to new highs by early 1972. But Graham noticed something. The rate of increase in prices during that last decade, it was slower than that post-war boom, like a moderation.
So things were calming down a bit.
In a way, yeah.
And remember, Graham wasn't just looking at these price movements. He was also interested in those long-term trends of earnings and dividends.
Absolutely. He dug into 10-year averages of stock prices, earnings, and dividends going all the way back to 1871.
Wow.
And the main picture, overall growth, consistent growth over the long haul. Out of those 9 decades after the first, only 2 saw declines in both earnings and average stock prices.
Interesting.
And after 1900, not a single decade had a decrease in average dividends. But the pace of growth, that varied a lot between different periods. He did note that the post-World War II period, that generally showed stronger performance than earlier decades.
Right. And I guess this sets up a comparison to what he was seeing in his present time, right?
Exactly. He pointed out that in 1970, corporate earnings had clearly weakened. The profit rate on invested capital was down, the lowest since the war years. He saw more companies reporting losses, having financial troubles.
Those some red flags popping up.
Yeah, some even faced big bankruptcies. This hadn't really been a thing for the past 3 decades.
So that post-war boom might be over, you're saying?
That was his concern.
It's interesting. And he also talks about a big shift in how investors were valuing stocks, particularly those PE ratios, price-to-earnings ratios, and dividend yields.
Oh, that's crucial. He contrasted the market in June 1949 with March 1961. Back in 49, the S&P composite was trading at a super low PE, just 6.3 times earnings, and the dividend yield was over 7%.
7%. So you were getting a good chunk of your investment back in dividends.
You were. Then by 61, that PE had jumped up to 22.9, and the dividend yield had dropped down to 3%.
That is a huge shift.
It is. And what makes it even more striking is that interest rates on good quality bonds, they actually went up during that same time.
Really?
Yeah. So Graham saw this as a massive flip in how people felt about stocks. They were much more willing to pay a premium for those earnings.
So less about that steady income from dividends and more about betting on future growth.
Right. And for a cautious, experienced guy like Graham, this raised some eyebrows. It reminded him of that speculative frenzy before the 29 crash.
And even though the immediate aftermath wasn't as bad as the Great Depression, wasn't the Dow in 1970 roughly at the same level it was 6.5 years earlier?
You got it. So all those soaring 60s gains, they hadn't really translated into sustainable growth for everyone.
Fascinating. Now, before we hear his specific take on early 1972, Graham also looks back at his own past market analyses.
Yeah.
What did he learn from those experiences?
Right. So he looked at his calls from 1948, 53, 59, 64, and honestly,
Yeah.
he found he'd been pretty spot on in the early years.
Ah, so he knew what he was talking about.
He did have some reservations in 53, though.
Okay.
But by 59, he was like, this market's dangerous.
Ooh, red alert.
And in 64, he thought it was too high. Now, he admitted that while he could still make a case for those judgments, their practical use for investors, that was debatable.
I see. Like, even if he was right, could anyone really have used that information to make better decisions?
Right. He felt his more general advice, invest consistently in stocks, don't try to time the market, that was way more beneficial in the long run. It just shows how tough it is to predict the market.
It's the age-old problem. Okay, so with all that in mind, what was his verdict on the market in early 1972 when the Dow was around 900 and the S&P was around 100?
So this time he focused more on the S&P 500. He felt it was a better picture of the overall market than the Dow. He compared things like PE ratios, earnings yield compared to bonds, and dividend yield compared to bonds. And he did this for several years, 48, 53, 58, 63, 68, and then early 72.
So he was creating a benchmark, a way to compare the present to the past.
Exactly. And while the PE ratio in early 72 wasn't crazy high, the relationship between bond yields and stock yields had shifted, and not in a good way.
In other words, bonds were looking more attractive than stocks at that point. That's unusual, isn't it?
It is, because usually stocks are seen as riskier, so they should offer higher returns to balance that out.
Right. Risk and reward.
Right.
So when safer bonds are yielding more, what does that tell us about stocks?
Well, it could mean stocks are overvalued or that investors are getting scared and moving towards safety.
Makes sense. So that shift really worried him.
Yeah, he said it outweighed the fact that the PE ratio wasn't super alarming, so his overall assessment of the market in early 1972, not great for conservative investors.
He was basically saying, be careful out there.
Pretty much, and this was very similar to what he had said back in late 1964.
So a consistent message of caution.
Right. Now, at the time, what was the general feeling on Wall Street? Was everyone as cautious as Graham?
What was the mood like?
Well, most people thought that the market's recovery in 1971 was the start of a new phase in that long bull market that began in 49.
So they were optimistic.
Yeah, they were expecting that bull market to just keep chugging along. And he did note that there wasn't crazy speculation in new stock offerings like there had been in past peaks.
But there's always a but with Graham.
There is. He was still bothered by how little the market seemed to care about that recent decline, the one in 1969 and 70. He felt it hinted at potential trouble ahead.
Okay, so Graham, ever the cautious one, even when everyone else was feeling bullish.
Exactly.
So that's Graham's view from early 1972, a mix of historical analysis and a dose of caution for the future. Now let's fast forward a bit and bring in Jason Zweig and see how he reflects on this and what insights he has for investors today. He starts his commentary with a really interesting quote from Graham himself.
He does. It goes like this. In my nearly 50 years of experience in Wall Street, I've found that I know less and less about what the stock market is going to do, but I know more and more about what investors ought to do.
So basically, the more you learn, the more you realize you can't predict the market.
Pretty much. But you can control your own actions, your own behavior.
Right. Focus on what you can control. And that's a big theme for Zweig, right? Less about predicting and more about principles.
Absolutely. He stresses that the market's unpredictable, despite the fact that it generally goes up over the long term.
And he dives into a really important point about how your personal financial situation can affect how you see and react to those market drops.
Yeah, he makes a key distinction. For people who are working, saving, building their nest egg, a falling market can actually be a good thing in the long run.
How so?
It lets them buy more shares of good companies at lower prices.
Look at sale.
Exactly. He even calls it rocket fuel for future wealth, of course, assuming the market recovers, which it always has.
Right, that's key. It's not a guarantee, but historically it's bounced back. So instead of freaking out when your portfolio dips, it's an opportunity.
Especially when you're younger and have time on your side.
Now, he points out that this isn't the same for everyone, though, right? For retirees, it's a different story.
Yeah, for retirees who need that income from their investments, a big market drop can be tough.
Because they have to sell, even at those lower prices.
Exactly. And if they need to maintain their living expenses, they might have to sell even more as prices fall. It just highlights how important it is to think about your age and your financial needs when dealing with a volatile market.
So one size does not fit all when it comes to investing.
Definitely not. Now, Zweig uses a really clever analogy to change how we think about market dips.
I'm curious, what is it?
It's called socks versus stocks. He says, imagine if stocks were like socks, and the price of your socks suddenly dropped by 20%. What would you do?
I'd probably buy more socks.
Exactly. You wouldn't panic and sell all your socks. You'd see it as a sale.
Time to stock up.
Right. He encourages younger investors to have that same Sox mentality with stocks. Buy when you need them as part of a long-term plan and see those price drops as chances to buy more, not as reasons to sell. It's a great way to show how we often react so differently to our investments compared to, everyday stuff.
I love that analogy. It really puts things in perspective. Now, Zweig also talks about modern tools that people use to try and gauge market valuation. One of those is the KP ratio, right?
Right, the cyclically adjusted price-earnings ratio. It was developed by Robert Shiller, and it's kind of inspired by Graham's work. It takes the current price of a broad market index, like the S&P 500, and divides it by the average of the past 10 years of earnings, but adjusted for inflation.
So it's looking at the price relative to a longer-term picture of earnings.
Exactly. It tries to smooth out those short-term ups and downs in earnings to get a better sense of whether the market's overvalued or undervalued compared to its historical earnings power.
I see. So a high CAPE would suggest that the market might be expensive, while a low CAPE might suggest it's a bargain.
That's the general idea. But, and this is key, it's not a perfect predictor of future returns.
So it's not a crystal ball.
Not at all. He gives examples where high CAPEs were followed by lower returns, like after those market peaks in 99 and 2000.
Right.
But then he also mentions times like after 2011 when the KPI was high, but the market still went up quite a bit in the years after.
So you can't just blindly rely on it.
The takeaway is that while KP can give some broad clues about long-term market valuation, it's not a foolproof timing tool.
Right. It's not telling you when to buy or sell.
Exactly. And Zweig points out that even defining a normal KP ratio is tricky. It's changed a lot over different periods of history.
So what's considered high or low has shifted over time.
Yeah, it has. So which historical average should we use to compare today's market to? It's a valid question.
And a tough one to answer.
Definitely. He mentions Professor Shiller, who suggests that market valuations are really about people's expectations of future value. What they think they can sell those stocks for later.
Okay, so psychology plays a big part.
Always. And those historical norms, well, they might have changed too, because of things like globalization or shifts in how people invest.
The world's constantly changing, so our ideas about normal change too.
Right. Zweig points out that U.S. stocks have actually traded above their long-term average CAPE pretty much since the late 1980s.
Wow, so for decades, meaning that markets can stay overvalued, at least by historical standards, for a long time.
That's the point. And it really echoes what Graham was saying about the difficulty of judging where the market is at any given time.
It's not an easy game to play.
Yeah.
Now, Zweig also brings up a simpler way to think about potential stock returns, the Gordon equation. What's that about?
So the Gordon growth model, or in its simpler form, the Gordon equation, it gives you a basic estimate of those long-term expected returns on stocks. It says you can get a rough idea by adding the current dividend yield of the market to the average rate at which those dividends are expected to grow.
Sounds straightforward enough. Got an example?
Yeah. So in early 2024, the S&P 500 dividend yield was around 1.4%. And if we look at the average inflation-adjusted dividend growth over the past 50 years, it was about 2.2%.
Okay, so you add those together, and what do you get?
You get a potential future return of about 3.6% after taking inflation into account.
3.6%. Not bad, but I guess it depends what you're comparing it to.
Right. Zweig points out that this is actually lower than historical averages, but it could still be enough for patient, long-term investors to reach their goals.
Okay, so slow and steady might still win the race.
Could do.
Now, there's this common belief that stocks always beat safer investments, like bonds, over the long haul. Zweig tackles this head-on, doesn't he?
Oh, he does. He mentions a survey from 2010 where lots of investors actually believe that stocks always outperform safe assets.
Really?
Yeah. Then he talks about Jeremy Siegel's famous book, Stocks for the Long Run.
I've heard of that.
It argues that stocks are inherently less risky than bonds based on data going all the way back to 1802.
So a pretty bold claim.
It is. And Zweig points out 3 major problems with that argument.
Lay out on me.
All right. So first, and this is a big one, survivorship bias.
Survivorship bias. We've heard that term before, but remind me, what is it exactly?
It's that sneaky tendency to focus only on the winners, the things that survived, and forget about all the losers.
Right. It paints a distorted picture.
Totally. And an economist named Edward Macquarie, he did research correcting for this bias, and guess what?
Yeah.
Bonds actually beat stocks in the U.S. for a big chunk of the 19th century.
Really? So the opposite of what Siegel's book suggests.
The opposite. And they also outperformed stocks in a decent percentage of all 20-year periods since 1793.
Interesting. So not as cut and dry as some might think.
Not at all. He also points out that in other major markets around the world, there have been times when bonds outperform stocks for decades.
So that stocks always win narrative isn't as universal as some people make it out to be.
Yeah.
What's the second problem?
The second point is that we can't compare past markets to today's. Back then, buying and selling stocks was much more expensive, and we didn't have things like index funds to easily diversify.
So stock investing was inherently riskier back then.
Much riskier, and that means those higher returns in the past were partly compensation for that extra risk.
Makes sense. Today, it's a different game.
Totally different.
No.
And the third problem, those historical return calculations often assume that people were consistently reinvesting their dividends.
Oh, right. Like every time you get a dividend payment, you immediately buy more stock with it.
Exactly. But in reality, many investors took those dividends as cash. They didn't reinvest. And that, of course, would have affected those long-term returns.
Yeah, if you're not compounding those dividends, your overall gains will be different. Okay, so survivorship bias, apples to oranges comparisons, and unrealistic assumptions about reinvestment. Those are some big caveats to keep in mind when looking at those long-term return charts. Now, Zweig uses a pretty memorable analogy to explain survivorship bias. Can you share that?
Yeah, it's the lumberjack analogy. He asks you to imagine visiting a nursing home that's only for retired lumberjacks. And after seeing all those elderly lumberjacks, you conclude, wow, logging must be a really safe job.
Because everyone's so old and healthy.
Right, but you're only seeing the survivors. What about all the lumberjacks who died young or got hurt on the job?
Right, they're not there to tell their story.
Exactly. And that's what happens in the stock market, too. We often only see the companies and industries that made it. We forget about all the ones that failed and disappeared.
So those impressive historical returns might be misleading because they don't account for all the failures.
Precisely. When you correct for that bias, those early stock returns aren't as impressive. Now, he does mention that data for the S&P 500 from the 20th century onward is generally not as affected by this particular bias because it accounts for companies entering and leaving the index.
So the S&P 500 data is a bit more reliable in that sense.
In that sense, yeah.
Now, there's also this whole debate about risk and whether holding stocks for longer reduces it. What's Zweig's take on that?
Well, he clarifies that holding for the long term does tend to reduce the short-term swings in returns, what we call volatility. But it doesn't get rid of the risk of losing money.
So you can still have those big drops, even if you're in it for the long haul.
You can. He uses the 2007-2009 financial crisis as an example. The U.S. stock market fell over 50%, and it took a long time to recover. He also points out that in various stock markets globally, there have been long stretches of negative returns, even after adjusting for inflation.
So time can help, but it's not a magic bullet.
Nope. You have more time to potentially recover, but also more time for those big drops to happen.
And lastly, Zweig talks about this paradox. Investors hate uncertainty. What's that all about?
He explains that if it were certain that stocks would always give you high returns with zero risk, then no one would see them as risky.
They'd be the perfect investment.
Right, everyone would pile in. But that lack of perceived risk would actually drive prices up to crazy levels, making a crash inevitable.
So the uncertainty is part of what allows for the potential for higher returns.
Exactly. If there were no risk, there probably wouldn't be much reward.
It's a balancing act. So after all this, what's Zweig's main message for investors, the big takeaway?
He says, the future of the market is a mystery. You can't predict it. So instead of trying to guess what's going to happen and build a portfolio based on those guesses, he says, focus on building a resilient portfolio.
A portfolio that can handle the ups and downs.
Exactly. Diversify, set clear goals, save consistently, and stick to your plan. Don't try to time the market or chase those hot trends. Control what you can control, and the rest will take care of itself over time.
So looking at everything we've discussed today, what are the key insights that our listeners, the learner, should take away from both Graham and Zweig? What's the core message here?
Well, Graham's analysis gives us this incredible long-term perspective on market cycles and how stock prices relate to those fundamental value indicators. It reminds us that those valuations change constantly. And Zweig, he brings a modern-day lens, reminding us how hard it is to predict what the market's going to do. He stresses knowing your own time horizon, your risk tolerance, and really seeing those market dips as opportunities.
And that flawed belief that stocks always outperform without any risk.
Oh yeah, a very important point to debunk. Ultimately, both their perspectives, even though they're from different times, highlight that uncertainty is part of the game. And the best way to play is with discipline, a long-term mindset, and a focus on value.
Absolutely. We hope this deep dive gave you, the learner, a richer understanding of the market's history and why it still matters today. Maybe even spark some aha moments along the way.
So think about this. With all this talk of market history and its unpredictability, what does a truly informed and resilient approach to your own long-term financial journey look like?
And remembering Graham's caution back in '72, even after a recovery, what are the rhymes you see in today's market? We really encourage you to keep those questions in mind as you continue navigating the world of investing and information.
It's a fascinating world out there.
It certainly is.